All right, let's talk about banking stocks. Today, we're going to crack the code. If you've ever looked at a bank and wondered how to tell if it's a great investment or a risky bet, you are in exactly the right place. We're going to give you a simple but really powerful framework to analyze any bank like a pro. So, how do you spot that winner before the crowd does? Well, it all starts with understanding something really basic: how a bank actually makes its money. Forget all the complicated jargon for a second. The core idea is surprisingly simple. Look, to get right to the heart of a bank's financial health, you do not need a finance degree. You just need to get a grip on two numbers. These two numbers tell you pretty much everything you need to know about its core profitability: net interest margin and return on assets. Okay, first up is net interest margin, or NIM. Think of this as the bank's main profit engine. It's really simple. Let's say a bank pays you 5% interest on your 100 rupee deposit. Then it turns around and lends that same 100 rupees to someone else for 12%. That gap, that 7% difference, that's where the bank makes its money. NIM just measures that profit spread across the entire bank's operations. So what's a good number to look for? Well, a top-tier bank like HDFC, for instance, consistently posts a net interest margin right around 4%. What that means is for every 100 rupees of assets it has that are earning interest, it makes a clean 4 rupee profit after paying all of its own interest costs. That is a really powerful sign of an efficient business. Now, this is where things get kind of interesting, because you have to completely flip how you normally think about money. For you and me, the money in our savings account is an asset, right? But for the bank, it's a liability. It's money they owe back to you. So what are their assets? The loans they've given out, because that's what's actually earning them an income. And once you get that, our second key number, return on assets, or ROA, makes perfect sense. If NIM is the profit margin on their loans, ROA tells you how efficiently the bank is using all those assets, all those loans, to generate a profit. You can think of it as the ultimate report card for how well the bank is being managed. So here's the key takeaway, the rule of thumb you need to remember. When you're looking at a bank's ROA, 1% is sort of the bare minimum for a healthy bank. But if you see a number that's getting close to 2%, now you're likely looking at an excellent, really high-quality operation. But, numbers alone don't make a great investment. If they did, this would be easy. Now we have to get into the art of analysis, the qualitative stuff that tells the real story, the one you're just not going to find in a spreadsheet. This quote just nails it. A machine can tell you what a bank earned, but it can't always tell you why, or more importantly, how sustainable those earnings are. To really understand a bank's strength, you have to look at the quality of its business, not just the quantity of its profits. First things first, where does the bank get its money? A strong bank has what's called a granular deposit base. All that means is it relies on thousands and thousands of small retail customers, people like you and me, instead of just a few giant corporate clients. It's so much safer because if one or two big clients decide to pull their money out, it's not going to sink the whole ship. And the exact same logic applies to the other side of the equation, the loan book. You never want a bank that has all of its eggs in one basket. A strong, smart bank diversifies its loans across tons of different sectors: car loans, home loans, agriculture. That way, if one industry has a really bad year, the whole bank isn't at risk. So right about now, you're probably wondering, okay, this is all great, but where on earth do I actually find all this qualitative information? Well, the answer is actually a lot more accessible than you might think. Every single publicly listed bank regularly publishes a document called an investor presentation. And trust me, this thing is an absolute goldmine. It's basically where the bank's management explains its strategy, its risks, and its performance in plain English directly to its shareholders. For example, in HDFC Bank's presentation, you might find a chart that looks just like this. It shows that a good chunk, 27%, of its revenue comes from non-interest income, things like credit card fees, commissions, or selling insurance products. That's a fantastic sign of a diversified and really robust business model. Okay, enough theory. Let's put this all into practice. Here is your step-by-step homework assignment to help you actually compare banks and spot those real opportunities. This is your action plan. Just open up a simple spreadsheet, list out maybe 8 to 10 of the major private banks. Then create columns for the key metrics we've been talking about: ROA and NIM. And add one more crucial one, the price-to-book ratio, or PB. All that does is it compares the bank's stock price to its net asset value. For banks, a lower PB can often mean better value. As you start filling this in, a really clear picture will start to emerge. And your final analysis might look something like this. You can see it instantly, right? Bank A is strong, but boy, is it pricey. Bank C seems expensive for its weak performance, but Bank B? It's got strong fundamentals and what looks like a reasonable valuation. That's the kind of opportunity you're searching for. And this, right here, is the million-dollar question that all your research is designed to answer. You're basically hunting for an outlier, a high-quality, well-run bank that, for whatever reason, the market just hasn't fully appreciated yet. But wait, before you jump in and hit that buy button, there is one last absolutely critical step. Come on, if finding a great investment were this easy, everybody would be doing it. You need a final reality check. So, you found a bank that looks great on paper. The numbers are solid, it seems undervalued. You have to stop and ask yourself, what am I missing? What does the market know that I don't? Because believe me, there's almost always a catch. Your final step is to play detective. Seriously, Google the bank's name with words like scandal or NPA problems. NPA just stands for non-performing assets, which is a fancy way of saying bad loans. Look for any big recent changes in top management. And always remember, the data you're analyzing is probably months old. A lot can change in a very short time. As we saw with a bank like Yes Bank, a bank's health can change dramatically, and it can happen fast. So there you have it, a complete framework for analyzing banking stocks. The process itself isn't all that complicated, but it does require patience and it does require discipline. The tools are now in your hands. The only real question left is, are you going to use them?